Brian, we're showing it now. Everything that investors are facing. You got the virus, the lockdowns, the pandemic. You've got increased China tensions. And of course, now you have civil unrest and mass demonstrations and protests across the country. I understand that you remain optimistic. I've read your research. But look at those macro events, none of which, with the exception of perhaps China and civil unrest going back years and decades, but not to this level, existed 2 months ago.
Well, good morning, Brian, from Minneapolis, where the behavior here is not indicative of how we actually are in Minneapolis. So our hearts and prayers obviously go out to the Floyd family. But at the end of the day, this has been a terrible event for our country. And what's going on with respect to trying to wrap this all into a bow, what you tried to do here during this hit is that we have a lack of confidence right now in our country. And it falls through with respect to what's happened in the stock market, certainly, and now in the overall aura and conscience of the country. So here's what we would say, and you focus on the word macro, and so many investors that we've cautioned investors that focus too much on macro and too much on quantitative analysis the last 20 years, and I think that's part and parcel why so many people have not been bullish, Brian, and how they've missed this move from March 23rd. If you take a look at valuation in particular, which tends to be one of the stumbling blocks for many of the bears out there, we're sitting at 2021 times, which is actually at or near 20-year highs, Brian. But if you take a look at the dispersion of valuation in the market, we have a 20-year high in terms of the difference between high valuation and low valuation in the market. So there are opportunities, and from a stock picking perspective, from an issue in terms of discretionary retail in particular. Courtney did a great job kind of teeing everything up. But at the end of the day, this is a sector that has had a lot of problems for 15 or 20 years in terms of capacity, and the stocks that have been hit the most and the companies that have been hit most due to some of this behavior with respect to rioting and looting will come back very strongly because they are, quote unquote, the staples. So I think some of this is going to be a little bit overblown, but we have a crisis in confidence right now. But at the end of the day, we still have to remember we're the best country in the world and the best companies in the world, and we will overcome this.
Yeah, I think that's well said. But, Brian, I mean, here's the other thing. I mean, you look at last night, New York Times, Wall Street Journal. I mean, name your publication. This is not opinion. There are real concerns among health experts that these protests could set off that second wave we worried so much about in the fall. Whether it will or won't, we don't know. But the market, at least when I look at the futures, doesn't appear to be pricing in the chance that many areas could be either re-locked down because of A, new second waves by millions of people across the country gathering and shouting in close proximity to each other. Number two, we have effective lockdowns already in some cities via curfews. And there's a very good chance, when I look at the futures, the Dow could rise today, Brian. That seems just hard to square for many people, I'm sure.
I think it's a simple math question and problem, Brian, where the potential percentage of people contracting COVID-19 coronavirus based on this behavior versus the amount of people that are actually going to go out and start buying things again and going back to work again. I think the percentages are clearly skewed toward the latter. And I know that this is all very frontline in terms of the headlines and things like that. But again, I'd caution investors to not focus on what's happening right here in terms of the headlines, in terms of the top 3 bullet points that we're all reading about, and kind of take a look at the bigger picture. And the bigger picture is the economy is opening up. People are going back to work. COVID-19 is getting better from a longer term perspective. And we have to kind of control what we can control. As a portfolio manager and strategist, you control what's going on in the stock market and control that the U.S. stock market actually, relative to the rest of the world, we believe from an earnings and cash flow and dividend perspective, remains the most stable house in an ever increasingly volatile neighborhood.
And you believe, when we talk about ratios and valuations, you mentioned earnings, PE ratios, whatever it is, you believe that, yes, these images and what we're dealing with as a country now, whether it's the pandemic, so many fatalities, George Floyd, the protests, that we have to look out a year, 2 years, 3 years, and realize that corporate America, businesses across this country will come back. And that's what you're investing for today, is that future. You're not investing today for tomorrow.
We're not. And I think so much of our reactions, quite frankly, and it goes back to March, we're reacting on today, tomorrow, the next few weeks, and people that are looking at this valuation metric valuation is a horrible metric with respect to future performance. It works longer term. But, riddle me this, Batman. How many people look out 10 years on a valuation on terms of PE? PE works when you're looking at markets over a 10-year time period or more. 1 to 10 year period, it doesn't work very well. So again, we think that the wherewithal of the United States economy, population, and stock market will win as we transition from despair to hope.
So yes, and there was some great scenes of hope in Michigan. You had that sergeant in Flint who led the protesters. He put down his hat and the batons. He said, "What do you want me to do? Walk with you? Okay, let's go." And they all walked together. There are signs of hope that we see here. So quickly, Brian, so no change to your forecast from a GDP perspective because of what we're seeing now, that the economy story will be the same now in a year.
It will be, and in fact, a lot of the economic data has been too negative. Our target for 3,400 by the end of March next year still stands pat in terms of the S&P 500, and some of the economic data again is coming in less negative than everybody thought, just like we warned people. So status quo, the bull market is going.